Hi, and welcome to the monthly outlook as presented by Centrum. I'm Manish Jain, the head of fund management. As we are speaking today, the markets are in a little bit of, shall I use the word turmoil? Maybe not, but a little bit of a correction mode. We are down about 300 points on Nifty, a little more than 1 percentage points. Why? Because over the weekend, there was a massive skirmish which broke out between Iran on one side and US and Israel on the other side. And that had a cascading effect on the entire Middle Eastern region, starting from Oman to Abu Dhabi, Dubai, going up to Riyadh, everywhere. Now, as an investor, should you be concerned? The answer is yes. Should you be aware of the situation? The answer again is yes. But let's look at the situation a little more objectively and dismantle it piece by piece by piece. Now, the first point is that the domestic economy, by all accounts, continues to remain on a very, very strong footing. Let's look at two set of numbers that came out last week, and they are all painting a very good picture. One is the non-food credit data as published by RBI. Points to a massive pickup in credit growth in the economy. We are looking at a number which is closer to 14% YOY credit growth, largely led by retail loan book, which has grown 14.9%, backed up by gold loans. So credit growth in the economy, which had been languishing at about 10% or thereabouts for a very long period of time, has finally shown signs of starting to pick up. The second point is the testimony to domestic economy being on a strong footing is that GDP numbers came out, and the number for third quarter was closer to 7.8% as compared to the market expectation of 7.2%. We are averaging a little more than 8% for the first 9 months of this current financial year. And again, a very, very strong set of numbers that have come through. So as far as domestic markets are concerned, when you look at the Q3 earnings growth, when you look at the GDP growth rate, when you look at the credit growth rate in the economy, when you look at asset quality numbers that the banks are producing, when you look at the consumption data across all the listed space and unlisted space that the companies are producing, I think you have nothing to worry about. Second point is on valuations. Now, equity markets in India have remained stagnant for almost about 18 months plus now. Mid and small caps have obviously underperformed the large caps during this correction period. But Nifty is now trading at somewhere close to a little less than 20 times valuation for an index where we are looking at closer to 15% sort of earnings growth next year. So 15% earnings growth, 16% return on equity, and 19x multiple, or a little more than 19x multiple, I think the risk reward is very, very favorably balanced. And when you look at sector by sector, again, the picture looks very, very good. There is obviously banks, which have reported a great set of numbers. There's auto, again, where, while in absolute terms, the stock may not have corrected a whole lot, but again, it's a growth-driven story. The numbers month after month, every month have been very, very strong. And the third one is IT, where some of these stocks are about 10% away from life low multiples. Life low multiples, I'm talking about life low multiples. Now, if you're not going to be buying these stocks now, I do not know when are you going to be buying them. Now, coming back to the point where we all started from, which is the international geopolitical situation. Now, just one more point before we come back to it is that the geo-economic situation globally has actually far more settled today than what it was a year back, especially the whole tariff situation. Right? We've already signed one FTA with UK, we've signed one FTA with Europe, and in a worst case scenario, we are looking at the tariffs on India from US perspective being at between 15 to 18% in that range, and not 50 as it was earlier. So particularly for certain sectors like, for example, textiles, for example, auto ancillaries, it's a great time, right? Most of the concerns are out of the way. Now coming back to the last point, which, where we had started off from, the skirmish. Now, this is not the first war in the last 6 years that have broken out. I think Russia-Ukraine was a far worse, had a far worse overbearing on the global economic situation as compared to what this skirmish has had. We are already witnessing signs of a thaw or a little bit slowdown. Both the parties are talking about a potential de-escalation in the situation. Is it going to be a long-lasting war like the Russia-Ukraine war was? My sense is not. Right? And if it is not going to be, and if it doesn't have a whole lot of permanent overbearing on the economy in India in particular, then I think we'll do well to ignore this and use the market correction which is happening right in front of us at this moment to invest more. Be bold, swim against the tide, buy when everybody's selling and sell when everybody's buying. And today, when despondency is creeping in, remember, as human beings, we typically tend to get caught in the cycle of greed and fear, and the impact of events is often exaggerated far beyond what it eventually turns out to be. So go ahead, buy quality stocks, wait for a year, by December, you would have made good amount of money. Happy investing.